I think when you're in your 20s and your 30s, that's the best time for you to start to look for things to invest in. And in this video, I just want to discuss some of the key concepts when it comes to investments and getting an understanding. So you may think that in your 20s, maybe you're not earning a lot of money as yet and you're not managing a lot of things at the moment. But I think that it's the best time for a person to consider investing, because the younger you are, the more time you have to try different things, and also you've got more time to bounce back, say you make a mistake or an investment doesn't go right. So that's what I want to discuss in this video. I'm going to do a two-part series. So in this video, I'm going to discuss key concepts when it comes to investments, and then in the second video, I'm going to discuss type of things that a 20 or 30-year-old can think about investing in at that age. So the first concept to understand when it comes to investments is equity. So I'm going to discuss in terms of equity for like investments, but just equity overall. So because I'm an accountant, I'm just going to start on that basis of understanding. So equity in accounting terms is that assets minus liability equals your equity. So investors will be interested in the equity increasing, right? So what accountants will do is to record the assets and the liabilities to show that, and then to show the equity that is due to the investors at the end of the period, right? So at a particular point in time, that's what investors use the financial statements for. They're used for decision making and whether they should continue to do this, or for strategy, basically. So that's why we as an accountant then will do the recording and prepare financial statements is for the investor and anyone else who may want to use the financials at the end of the day, like banks, or for tax purposes, or also comparing it to other companies in the same industry as yours, right? So assets are anything that the company owns, and liabilities are anything that the company owes. So an asset could be like cash in the bank, or it could be property that the company owns, and they'll use that asset to generate more money in the future. That's in simple terms. And liabilities is anything that the company owes. So for example, wages that they have to pay at the end of a particular period, or loans that they've taken out and the interest on those loans. So that's in accounting term, that's the equation for equity. That's the accounting equation essentially. So that's asset minus liabilities equals your equity. So when it comes to like an investor, so why you'd want to know this as an investor, and a young investor at that, is that say you want to invest in a startup. So for example, you have maybe 10,000 Rand, and you'll say, okay, your buddy wants to start a company. So you're going to invest in that company and give him 10,000 Rand. For a stake, for example, maybe you'll say, for this 10,000 Rand that I'm going to give you, please give me 10% of your company. So it means that you're an owner of that company. So you've got a stake holding in that company for 10%. So you've got a vested interest in that company doing well, because you are also part of the shareholders of the company. So those are one of the ways that you can also invest. So that is equity. So you buy a stake in a company. So you basically purchase shares and you're like, okay, this is what I'm putting in the company. So from the company point of view, the company owes you that money because they've taken this 10,000 Rand from you, and they're going to use this 10,000 Rand to hopefully make more money. And you as an investor, what you'll be interested in is that your equity keeps on growing every single year, because that's what you want to see. You want to see your 10,000 giving you back value, giving you back interest, right? And then at the end of the day, maybe the company will give you dividends and those type of things. So you earn your income back into like by dividends. So the company does well. They're like, okay, cool. We've done this much profit. This is how much we're making. So we're going to give our investors a particular percentage or particular amount as dividend payments. So if you're an owner, you are a shareholder of that company, and you can basically say that that's also your company. So that's equity. So when you're buying it, you're interested in the company doing well, and the people in the company want to use whatever money that they get to generate more money, so that everybody comes off with the win at the end of the day. So that is equity in a nutshell. This type of investment is risky, and the reason why it's risky is because there are high chances that the business is not going to succeed or go well, unless if you are lucky and you invest in the next Apple or Facebook or something like that. But most of the time, the stats show that many companies that start don't actually make it past the first year. So it's a very risky form of investment. But the nice thing about being in your 20s or your 30s is that you are given the opportunity to take more risks because you've got more time to bounce back if you make a bad financial decision, and you can also use that financial decision that you've made, like say you fail at something, you put money in some way and it doesn't give you what you want. You're able then to then have enough time or more time to bounce back, learn from it, and then maybe try again in future with more knowledge on your hands. So it's definitely something that you could consider doing, but however, generally it is known as a more of a riskier investment when you want to invest in a startup. The second type of concept that I think is important to understand is debt financing. So the first part of the video we spoke about equity, and this debt financing is basically talking about loans. So if you want to, instead of investing in your friend's business, you say, okay, this 10,000 rand, instead of that, I'm going to loan you this 10,000 rand, and I want, and like I'm going to charge you an interest of 10% in 2 years' time. So there you are guaranteed in a way to get your money back. So you don't have a stake holding on interest or invest or like a stake in the company itself, but the company owes you money and it owes you interest after 2 years. Eventually, they'll have to pay it back depending on the terms and the agreements that you come into with your friend or your entrepreneur friend or whatever business you're getting into. But it is, you're going to know all the terms and the conditions upfront when you come to that agreement. So that's the difference between equity, where you get a stakeholding in a company, and debt financing, where you loan a company money and that company is going to give you interest after a certain period, depending on the terms that you charge, or the terms and conditions that you give this company when it comes to the debt that you give them. And the difference between equity and debt is that the debt you're going to get after a certain period, you're going to get your interest back, or they're going to have to repay you back after a certain period, and it's got a time limit on it, right? But then equity, for example, is unlimited. So unless you sell your share to somebody else, or your stakeholding in that company to somebody else, you have an interest in that company for a longer period. So you may be lucky in that you invest in that company, and after 5-10 years it's done so well, and the value of your equity has gone up so much, and you can actually make more money by just leaving it in there and hoping that the company does well, and that the return on your investment is much higher than, for example, the debt finance that you'll give the entity. The third one is cash. So cash, that's just cash that you put in the bank and you just leave it there. This one is less risky. So there's not much risk on this one. However, the returns are also very low. So high risk, high rewards, low risk, low reward. So here you just invest money, or you just put it into your bank, and the bank gives you a certain percentage every year or every month. But you don't actually earn that much from it, but it's definitely safer than a startup or debt finance or something like, or some other option. And the fourth one is property. So property is anything from a house, apartment, or any other block, or any other real estate. So here you can either invest in this via debt financing or equity financing, and it's a very volatile type of financing, and you'll have to do a lot of research to find out the area that you are wanting to buy property in, or whatever it is that you're trying to get into. This one requires a lot of research, and I definitely would recommend that you do research before you get into this kind of an investment, because it's very volatile. The market can be volatile, but it can also give you good returns if you do things right, the right way. So even if the property doesn't do well, you still have the property to fall back on, and you may lose that investment that you put into the property, but you can sell the property and recoup some of that investment. So there's a bit of secured there's a bit of security there because you've got a physical property that you can sell and recoup some of the money that you would have initially invested in by selling it. The rule of 72 is you take 72 and you divide that by the rate of return that they are giving you, and that will tell you how long it will take you to double your income. So say for example the rate of return is 8%, right? So you take 72 and you divide that by 8, and that will give you 9 years. So it will take you 9 years to double your investment. It's a good indicator to show you how long it will take you to double your income and whether you actually want to be to do it for that long. If your bank offers you 2% annual return on your money, it will take you 36 years to double your income. So you take 72, you divide that by 2, and then it will take you 36 years to double your income. So you can see that the bank has lower risk in that it's at the bank, you know, barring nothing happens to the bank, your money is safe, but it will take you 32 years to double the amount that you put in there. So it's very, very low returns. So yeah, so it's just something to think about. So the rule of 72 is a good idea, just to gauge to see how long will I take to double my income. The younger you are, the better it is for you to start investing. So it's never too early. It's actually better. It's actually advisable to start early as possible because it allows you to make um, bolder decisions, riskier decisions, if I could say, because the older you get married, you've got financial commitments, and you cannot always use your money for investment. But the younger you are, the more you can bounce back quickly. You've got longer years. You've got you've got more years to catch up and to learn from it. So it's 100% like the best idea is to start as early as possible. It's advisable to speak to a financial advisor because financial advisors will get to know you, get to know what your goals are. They'll get to know what it is that you want for your future, and then they'll tailor plans that are specific for you. So it's always, always a good idea to just speak to someone to say, okay, this is how much money I have. This is how much I want to save for now, and they'll then tailor a plan for you to reach your financial goals for your future. And also, as you go older and older and older, and you're earning more and more and more, it's also a good idea to then save a little bit more so that your investments keeps growing. So you have more financial security and you can have a better future in the long run. Compound interest, it can benefit younger people as well because say for example you are 25 and you start investing 500 rand now. So that 500 rand will earn interest on interest on interest, and you'll make money as you grow older, and say you will retire at like 65. So you've got 35 years of making compound interest. However, if you start investing at 35, you only have 25 years to earn compound interest. So the younger you are, the better it is for you to start investing to maximize the amount of money that you can make in the future. So you can see in this example what it's saying. It's saying start compounding now, right? So the sooner you start, the more money you're likely to make in the future. So if you wait for it for too long, you can see that as the person is getting older, Jack started at 25, Jill started at 35, and Joey started at 45. Joey has a shorter time to make money, and she won't, by the time she reaches 64, she wouldn't have made as much money as a Jack or even a Jill. So the younger you are, the better it is for you to start investing in your future. One also must think about what what they can invest in, and this you can do via budget. So you do a budget, and you put on your budget how much money you make, your income, and you also put in your expenses, and you divide your expenses in fixed and also variable. So fixed are things like rent, things that don't change, and variable are things like fun stuff. Variable are things like fun stuff. So anything that varies, like entertainment, right? How much you go out to eat, how much you buy takeouts, how much you buy coffee. Those things are things that you can control and things that you can do without. So those are variable costs. But there's other expenses that are fixed monthly expenses that are in your budget. So you take your income minus your fixed expenses minus your variable expenses, and then it will show you your disposable income at the end of the month. in that you can then say, okay, out of this, I can save 500 Rand or 200 Rand, and then speak to a financial advisor, let them tailor specific needs for you, let them tailor a specific plan for you, let them ask you questions and what it is that you want for your future, and then that is the best way to go. So the earlier you do this, the better it is for your future. So if you're 20, much better, if like way better. And if you're 30, it's also advisable to start now. In the next video, I'm going to speak about the different types of investments that are available to 20s and 30-year-olds in South Africa, anybody really, but it's mostly for beginners. And I hope you check that out, and I'll link it somewhere around the description or up in the cards when it is available. Thank you guys for watching, and I'll see you on the next one. Goodbye.